Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest-growing regulated all-in-one trading and investing app. Whether you're looking to invest in U.S. stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
Welcome back to the Deep Dive. If you've glanced at your portfolio lately, or, well, just follow the news, you'll know why our sources are calling the crypto market a complete bloodbath.
Yeah, bloodbath feels pretty accurate right now. The volatility we're seeing is honestly quite staggering. The global crypto market cap is down to around $3.55 trillion.
$3.55 trillion still sounds massive, doesn't it? But put that in context for us. How big a drop are we actually talking about recently? Is this just market noise or something more?
Oh, it's definitely more than noise. It feels like a shift driven by, well, fear. We've seen almost $500 billion wiped off the total market value in roughly the last month alone.
Wow, $500 billion.
Exactly. And that kind of collapse has dragged Bitcoin down to somewhere around $106,000. When you lose that much value that quickly, the whole narrative changes, from innovation to just survival.
Right. So our mission today is to try and make sense of this. We've got this perfect storm brewing, big hacks, serious regulation fears, macro pressure. But at the same time, some huge institutional players like Fidelity, Ripple, and Circle are making major moves.
It's a real paradox. Chaos on one side, infrastructure building on the other.
Exactly. So let's dive in and unpack how this turbulence might actually be shaping what comes next for digital finance.
Okay, let's start with the current market picture, that fear you mentioned. It's definitely showing up in the numbers. The sentiment index is down at 27, which is deep in fear territory.
Yeah, and you see it across the board. Most major coins are in the red. Bitcoin's down over 1% in the last day. Ethereum down over 3%. It just paints a picture of widespread anxiety.
But amidst all that red, there are these weird outliers, right?
That's what's so fascinating. While the big names are tumbling, some specific types of coins are actually booming. It shows the market's not moving entirely in lockstep. You're talking about privacy coins. While Bitcoin and Ether are dropping, these are like skyrocketing. Give us the numbers, because they sound pretty wild.
They really are. Decreed is up something like 160% in just 24 hours.
150%.
Yeah. And Dash is up over 66%, Zcash up over 21%. It suggests that when confidence drops in the main market, some people are rushing towards assets they see as more decentralized or maybe uncontrollable.
Okay, so why the big crash everywhere else? Sources suggest this privacy coin rally is linked to regulation fears. But what's causing the broader market meltdown? Is it just nerves or something deeper?
It seems to be a mix. The analysis we're seeing suggests maybe 50% to 70% of the pressure is from, wider macroeconomic factors and just necessary market regrouping after a big run-up.
Okay.
But the other 30% to 50%, that seems to be technical cleanup. Basically, the market is still dealing with the fallout from last month's volatility. Remember those huge liquidations?
Oh, yeah, that was massive. Wasn't it like $19 billion?
Over $19 billion in liquidations. Shocks like that take time to wash through the system. The market's still fragile from that.
And the big institutional players, they're reacting predictably, I assume, heading for the door?
That's what the ETF flows suggest. We're seeing really significant outflows.
How significant?
In the last 24 hours alone, net outflows of about $291.85 million. Bitcoin ETFs saw the bulk of that, over $213 million. And Ethereum ETFs lost another $78 million or so.
Wait a minute. If institutions are pulling out nearly $300 million in a single day, doesn't that just make the problem worse? Like they're causing the drop they're trying to escape.
It absolutely accelerates it, yeah. When that much money leaves, it drains liquidity from the market. So any selling pressure after that has a much bigger impact on the price. It becomes a bit of a self-fulfilling cycle, a rush for the exits, like you said.
And what's fueling that institutional caution? Is it just the price action, or is there more? We're hearing a lot about regulatory anxiety, particularly around something called the U.S. Genius Act.
That's definitely part of the chatter, especially among traders. Stablecoins are like the plumbing of the crypto market. They're the safe harbor people use to move between trades or sit out volatility.
Right.
The worry around the Genius Act is that it might impose really strict rules on stablecoin issuers. Things like very high capital reserve requirements, or maybe new levels of auditing and oversight.
And if that happens?
If that happens, traders fear it could seriously squeeze liquidity across all the exchanges. Less stablecoin liquidity means it's harder to trade, harder to move money around. So even the fear of tighter rules causes panic.
And that's probably amplified by the general economic uncertainty, too. Sources mention the ongoing U.S. government shutdown, pinning it on the Democrats. That can't be helping market mood.
No, exactly. Political instability, regulatory fears, it all just adds to the negative sentiment and pushes people towards assets that feel outside that system, like those privacy coins we mentioned.
Okay, so we've got macro pressure, regulatory fears, but then there's the internal stuff. Nothing shakes confidence like a massive hack, and Balancer just got hit hard. Yeah, they're a pretty big name in DeFi, right? One of the older platforms.
Yeah, Balancer's been around a while, a major decentralized exchange. And this exploit was huge. We're talking roughly $160 million worth of staked Ethereum, including things like wrapped Ether and Lido staked ETH.
$160 million just gone.
Pretty much. Siphoned off into a new wallet. And experts seem to think it wasn't user error, but likely a bug in the smart contract code itself, a flaw in the platform's foundation.
That's kind of the nightmare scenario for DeFi, isn't it? If the code itself fails.
It really is. It goes right to the heart of what people call fragile trust. Every time something like this happens, it reminds everyone that in DeFi, unlike traditional finance, there's no safety net. There's no FDIC insurance, no customer service involved to call if your money vanishes because of a bug.
So facing that reality, $160 million gone, probably due to their own code, Balancer's response was, well, surprising. They offered the hacker a bounty.
Yeah, they essentially offered the hacker a deal, a 20% white hat bounty, which works out to about $20 million, if the hacker returned the other $140 million within 48 hours.
Wow. A public negotiation with the thief?
Pretty much. It's a high-stakes gamble, trying to salvage most of the funds.
But doesn't offering $20 million just reward the crime?
Yeah.
Isn't there a risk that this sets a precedent? Hack us, give most of it back, and you get to keep millions tax-free, presumably.
That's the huge ethical and practical problem they face, absolutely. It sends a terrible message. But from Balancer's perspective, it might be the only pragmatic way to try and recover the majority of their users' funds.
So it's damage control.
Exactly, which is why they also made a very clear threat alongside the offer. Cooperate, or we'll throw everything we have at catching you. They claim they already have metadata and IP address logs, so it's part negotiation, part ultimatum. A real crypto Wild West situation.
Okay, so while that $160 million DeFi drama unfolds, with hackers and bounties, the traditional finance world seems to be just marching forward, making these big, regulated crypto moves. It's such a stark contrast.
It really highlights that split we talked about. Traditional finance sees the crypto volatility and thinks their regulated structures are the answer. Take Fidelity International, for example.
Right. They just got the green light in the UK from the FCA, didn't they? To offer their Bitcoin ETP to regular retail investors.
Exactly. The UK Financial Conduct Authority approved it. This came after the FCA lifted a ban back in October, so now UK retail folks can get Bitcoin exposure through a familiar regulated product. It's a big regulatory stamp of approval.
So more regulated access.
Yes, but what's interesting is Fidelity is also giving users more crypto-native control at the same time.
How so?
Well, for the first time since they launched their retail crypto service a couple of years back, users can now actually send and receive Bitcoin to their own external wallets. They're calling it full self-custody control.
So regulated product on one hand, more user autonomy on the other. Interesting balance.
It is. They seem to be trying to bridge both worlds.
Okay, and then moving over to the US, Ripple's making a big institutional play with something called Ripple Prime. This sounds like they're going head-to-head with exchanges for big money clients.
That's exactly the angle. Ripple Prime offers spot crypto trading directly to U.S. institutional clients. They can trade Bitcoin, Ethereum, Solana, even Ripple's own stablecoin, RLUSD.
And this came after they bought that company, Hidden Road, right, for like $1.2 billion.
That's right. That acquisition gave them the prime brokerage infrastructure, the tools big funds need, like margin trading, custody, that sort of thing. They basically bought their way into becoming a full-service institutional platform.
So they're building a regulated bridge for institutions to trade crypto.
Precisely. And they seem to be positioning themselves to take advantage of what sources describe as an extremely supportive U.S. regulatory environment right now, at least for these kinds of regulated enterprise-focused solutions.
Which brings us to Circle. They issue USDC, the big stable coin, right?
Yeah.
Billions in circulation. Now they've launched their own blockchain, Zark. And this was causing some friction, it seems.
Yeah, Circle launched the public testnet for Zark. They're pitching it as an economic operating system for the internet, promising, faster, cheaper, more secure payments, all the usual buzzwords.
Okay,
But
get it.
the key detail is Zark is 100% centralized. It launched with a consortium of 100 global partners.
So these partners aren't small names. We're talking BlackRock, Visa, HSBC, Amazon Web Services, MasterCard.
Exactly. It's a who's who of global finance and tech giants.
So what's the problem? Faster, cheaper payments sounds good.
The problem, or the tension, for the crypto community is that Zark, despite using blockchain tech, seems to run completely counter to the original decentralized ethos of Bitcoin.
How so? Because it's run by big corporations.
Essentially, yes. If AWS is hosting the nodes and banks like HSBC are part of the governing consortium, then the network is fundamentally tied to banks, governments, and corporate control, as some critics put it.
Okay, break that down for me as an end user. If AWS or MasterCard is involved, how does that actually limit things like censorship resistance?
Well, it means that the companies running the network, nodes, the consortium members, are subject to legal and regulatory requirements. If a government agency tells them to block a transaction or freeze an account, they likely have to comply. There's no real anonymity, and censorship resistance isn't guaranteed, like it theoretically is, on a truly decentralized network like Bitcoin.
So it's using blockchain for efficiency within a traditional control structure.
You could say that. It's a very powerful payment system, potentially, but it's definitely not decentralized digital cash in the way crypto purists think of it. It's more like Fintech 2.0, built with blockchain components.
This idea of centralized, corporate-driven blockchain utility, it seems to be finding a really receptive home in places like the UAE, right? They're pushing hard on both AI and blockchain integration.
Absolutely. The UAE is really positioning itself as a leader here. Look at Microsoft's commitment.
Yeah, that investment number is staggering. What is it?
Microsoft is putting a massive $15.5 billion directly into the UAE between 2023 and 2029. That's specifically for building out AI and cloud data centers there.
$15.5 billion.
Yep.
And that includes shipping and top-tier hardware too, right? Like
Yeah.
advanced NVIDIA GPUs.
Yes. Thousands of them. High-end chips like the A100 and GB300 equivalents, all licensed for export by the U.S. Commerce Department. It's a huge transfer of cutting-edge AI infrastructure.
Why the UAE specifically?
Well, the demand is apparently huge there already. Sources note the UAE leads the world per capita in AI usage. Something like almost 60% of the population is using generative AI tools. They're embracing it rapidly.
And this tech push connects to their blockchain ambitions. We saw news about the Abu Dhabi Real Estate Center using blockchain.
Exactly. They're partnering up to integrate blockchain into the property sector. The goals are, improved transparency, more efficient transactions. They're starting with pilot projects for things like property registrations and validating titles.
Okay, using blockchain for property records sounds sensible. More secure, harder to tamper with.
That's the idea. But there's a really important caveat here that often gets overlooked, especially with these kinds of enterprise blockchain projects.
Which is?
Using blockchain doesn't automatically make the data more accurate.
Huh. I thought that was the whole point. Immutable records mean accurate records.
Not quite. Blockchain makes the record secure and tamper-proof once it's entered, but it doesn't verify the initial accuracy of the data being put onto the blockchain.
So garbage in, garbage out.
Precisely. If someone uploads incorrect property details, wrong size, wrong owner of the blockchain will perfectly and permanently secure that incorrect data. And because it's immutable, fixing that error later can be incredibly difficult, especially in these likely permissioned corporate or government-run systems.
So the real challenge isn't just the tech, it's ensuring the data fed into the tech is right in the first place.
Exactly. The security of the ledger is only as good as the accuracy of the information put on it initially. Hashtag, outro.
Okay, so when we step back and look at everything we've discussed, the crashing decentralized markets, that huge balancer hack, but then these massive institutional projects like ZARK and the moves by Fidelity and Ripple, it really feels like the digital asset world is splitting.
It really does seem like a bifurcation, yeah. You've got one path heading towards regulated centralized utility. Think ZARK, think institutional ETPs, think Microsoft's AI push in the UAE using controlled tech. It's about compliance, efficiency, corporate control.
And the other path?
The other path remains this volatile, permissionless, decentralized world. Still incredibly innovative, but also, as we saw with Balancer, highly vulnerable to security failures and prone to these wild swings driven by fear and macroeconomics.
So what does this all mean for you, the listener, trying to navigate this space?
Well, it highlights this fundamental tension. Are we moving towards a future dominated by regulated corporate blockchain systems that prioritize stability and control? Or will the original decentralized permissionless ideal survive and find a way to overcome its challenges?
And that $160 million balancer hack feels like a key event here. It's the kind of thing that inevitably forces regulators to look closer at DeFi.
It absolutely puts pressure on them, which leads to the big, provocative question, I think. As regulators inevitably step in, trying to protect users from these kinds of losses in DeFi, will that increased oversight inadvertently stifle the very innovation and creativity that made the space so exciting in the first place?
Could trying to make DeFi safer actually push all the money in development into centralized corporate structures like ZARK?
That's the fear for many in the community. Will regulation, meant to protect, end up killing the creativity and force digital finance down a more centralized, perhaps less revolutionary path? Which future ultimately wins out? That's what we'll be watching.